Simon Popple, investment expert and managing director of Brookfield Capital. It's great to have you with us. Simon, gold has been a hot topic recently as US President Trump's trade policies have sent prices to record highs. But can you explain a bit further exactly why people are putting gold in their portfolio now?
Right. Well, I mean, I think gold is a long-term investment, and it's viewed as a hedge against inflation. And when the world is worried, you've got geopolitical risk, you've got very high debt levels. Gold's been around for thousands of years, and I think that investors who perhaps didn't look at it in the past start to look at it now, and I think it's become far more relevant to the investment community than perhaps it used to be.
And we mentioned President Trump there, but I want to ask you, what are the other key factors that are influencing gold prices today?
I think there's actually quite a lot of factors influencing the gold price. I mean, one is obviously debt. The world is increasingly becoming more indebted. You've also got worries of inflation, especially with Trump and his tariffs. I mean, that could make things very expensive with the retaliatory tariffs as well. And I think there's a lot of uncertainty. I think we've lived in a world where we had far more certainty than perhaps we do today. And I think that the uncertainty is moving people more towards what are considered safe haven assets such as gold, rather than perhaps some other sectors that they previously were interested in.
And prices are high at the moment, but is it always a good time to invest in gold?
I think it is. I mean, I think when you say prices are high, I mean prices are high relative to where they've been. If you compare the current bull market with the one in the late 70s, early 80s, the price could actually go a lot higher. And I think people who are waiting for the price to come down could be sadly disappointed because perhaps it doesn't. Unfortunately, we don't know. But I would advocate that if you're thinking about investing, perhaps put 30% or 50% of what you want to invest in today. If the price continues to go up, you can then decide whether to put more in at a higher price or ride out the good days. And obviously, if the price comes down, then you've got an opportunity to invest at a lower price. So unfortunately, we don't know, but I would strongly advocate that people at least jump in and have some exposure, no matter how big or small.
And I'd just like to go back to something you mentioned earlier. You said that gold was a hedge against inflation, but how safe of an asset is it really?
Gold prices go up and down, and inflation tends to go up. So there are times when gold hasn't been a good hedge against inflation, but there's times when it has been a very good hedge against inflation. And so I don't think there's a perfect hedge against inflation. And I think the important thing to remember here is we're talking about your personal level of inflation. If you buy any product, it is linked to probably CPI or RPI. But your personal level of inflation might be much higher. So, if you've got a product that's, let's say, giving you CPI, which I think is, I don't know, about 3.5-ish, then if your personal level of inflation is more like 9, then you're not really getting the protection that you want anyway. So it's a very personal thing. And I think the other thing is it's got global appeal. I can't think of many assets that have got global appeal. So if your currency takes a bath, then you'll probably find there's still strong demand for it elsewhere in the world. And it's not like a property or something like that, which is very much linked to your domestic market.
Simon Popple, thank you so much for sharing your insights on Euronews.
That's great. Thank you very much.